Well, it's a big day. Reliance Industries is all set to announce its Q4 earnings. Remember, the stock is down 7% in 2023 so far, but it's a decent quarter expected this time around. First, let me take you through all the key numbers that you can watch out for. On the revenue front, it's about an 8.5% growth that we're looking at compared to last quarter. While on the EBIT, the EBITDA could see a growth of around 5.2%. Margins could be a tad bit under pressure compared to what Reliance did last quarter. But on the profitability front, it's a 12% growth that we're looking at somewhere around 17,700 crores. Now, as I said, both the consumer as well as the commodity businesses for Reliance Industries have done decently well this time around. First, let's take a look at the oil to chemicals business, which is a key reason for the recovery this quarter. There's a sequential recovery that we're expecting for a couple of reasons. A stronger base gross refining margins and lower windfall tax is something that can aid this segment for them. In fact, looking at the gross refining margins, Singapore gross refining margins improved to $8.2 a barrel in Q4 compared to $6.3 a barrel last quarter. There's also a demand improvement seen because of the China reopening, and that has aided the numbers this time around. In the consumer-facing businesses, Reliance Jio has slowed down a tad bit, so we are seeing the revenue and the profitability growth moderate for them. In fact, it could be the lowest in the last 7 quarters. On the average revenue per user as well, it could be absolutely flat this time around at 178 rupees. A couple of reasons for the slowdown, but primary reason is that there's been an absence of a tariff hike, and that has caused Reliance to see a slowdown in its growth rate in the telecom business. Let's move to retail now. Retail growth is expected to be about 6% on a sequential basis, coming in at a little over 46,650 crores. These are the recommendations put out from Nomura. And on the EBIT side, we're expecting about 3,800 crores versus 3,600 crores last quarter on a sequential basis. So clearly, as you've seen, there's a decent growth expected. Some of the businesses like Rel Jio could see a bit of a slowdown, but it could be offset by good growth in the oil to chemical space.
Well, it's expected to be a modest quarter for Reliance Jio this time. We're looking at a revenue growth of 1.8% on a quarter-on-quarter basis. And this, by the way, will be the slowest revenue growth that we've seen in the last 7 quarters. The key reason for that is the absence of a broad-based prepaid tariff hike. While the company has been getting a bit aggressive on the postpaid side, they've introduced a lot of family offerings, it doesn't move the needle on the top line. On margins, the company's margin trajectory has been upward, and this quarter too, we are anticipating a 40 basis points improvement in margin sequentially, driving a 2.5% increase in the profitability. 2 key operating metrics. One of it is subscriber, which is basically your volume growth, and the other one is ARPU, which is your pricing growth. So in the month of January, according to the TRAI data, the company added 1.65 million subscribers. So analysts are anticipating that for the full quarter, the subscriber addition should be about 5 to 6 million. In terms of ARPUs, the average revenue per user, it's seen flat on a sequential basis. 178 rupees is the ARPU estimate according to consensus expectations. And as I said, the key reason for the ARPUs being flat is the absence of a large prepaid tariff hike.
Well, for Reliance's retail business, it's already been on a big growth path. So this time around, year-on-year growth as well as quarter-on-quarter growth is something that the street is working with. Remember, usually post the 3rd quarter, there is a slump, but the company's store expansion will offset this post-festive season slump as well. And year-on-year, the numbers will look much better because of, one, the network expansion, and secondly, a strong, favorable base for the company because of Omicron-related issues in the same time last year. So quarter-on-quarter, revenue is likely to grow by 4.5%. For the first time, it crosses that 70,000 crores per quarter mark. The EBITDA grows by 2%, just under that 5,000 crore mark, which means that the margins for the company meander around that 7% mark itself. These are Nomura's expectations. Year on year, like I said, a 22% growth in the revenue looks much better, a 31.5% growth in their EBITDA as well. The company's foray into the FMCG business, Independence, the brand that they launched a couple of quarters ago, is something that we'll be watching out for. Apart from that, they've expanded their horizon as well, entered into the personal care and home care categories too. And more than anything else, they've recently launched the beauty care platform too. So these are some things that we'll be watching out for. The heat wave is on, so the acquisition and launch of Campa as well as Socio is something that the street will be watching out for, but that may be more of a 1st quarter phenomenon, and eventually Metro AG's India business coming into them is also going to help the retail business grow, the growth path that it already is on.
Well, it is expected to be a good quarter for the oil to chemical segment for Reliance Industries in quarter 4, driven by a lot of factors. Let me start with the first one, crude oil prices. They were lower on a YOY and in a sequential basis, 19% decline on a YOY basis, 8% on a sequential basis. Additionally, Singapore GRMs, they have seen a ramp up, coming in at $8.2 per barrel. Now, if we talk about what this will do in terms of refining and petchem segment, demand was seen improving in the Chinese economy because of China reopening. That is something which is important. However, elevated Chinese exports capped gains on product spreads, and that's why while refining will do well, petchem segment will still be lower than historical averages. But yes, it will see an improvement on a quarter-on-quarter basis this time around. If we go by the estimates, Jefferies expects that EBITDA will go up by 10% on a sequential basis and 7% on a YOY basis. Now, quickly taking a look at how this particular segment contributes to overall earnings in terms of EBIT. It was at one of the highest levels back in quarter 4 FY22 at 91.8%. It fell sharply, but then since then it has been seeing a gradual improvement, and at 79.9% is the EBIT contribution to overall consolidated EBIT is going to come in from oil to chemicals according to ICICI Securities. Let's move on and talk about GRMs. The company doesn't report them anymore, but there are some estimates that it could come in at $12.8 per barrel, which is higher both on a YOY and on a quarter-on-quarter basis. This is about oil to chemicals. Moving on to the upstream segment, that has been doing really well for the company, and it will not be an exception this time around as well. A 5% increase on a sequential basis and more than 100% on a YOY basis is what is expected at 40,740 crore rupees. That's going to be the upstream EBITDA this time around. So both these segments are going to do really well, and that is the expectation from Reliance Industries.